The FDIC is seizing banks. 160-year-old financial institutions are getting 54 billion bailouts. What in the world is going on? Now, if you have your money invested, you might be concerned, and I totally get it. I would be concerned too. Today, I want to answer some key questions about what happens to your money, whether it's invested at a bank or if it's invested at an investment firm like an online brokerage. Is your money safe? Is your money protected? What do you need to know? We're going to answer all those questions and a whole lot more right now.
What's going on, y'all? Welcome back to the channel. If you have your money invested in a bank, if you have your money invested in a brokerage firm, you might be concerned, and rightfully so. There have been headlines after headlines about banking crisis. We've seen banks shutting down. We've seen a run at banks. There have been talks about a global financial crisis going on right now. So my goal with this video is to put some of those rumors to rest, put some of those fears to rest, and address your most important questions. First things first, if you don't know who I am, my name is Jeff Rose. I'm a certified financial planner. I was a financial planner for 16 plus years, had my own wealth management firm, my own RIA, until I sold it to focus on the online business, hence the YouTube channel, podcast, the blog, goodfinancialsense.com. So I know a thing or two about what is going on and how your money is safe and what you need to know. So today, what I really want to dive in and I want to answer is, what about your money that is invested with some sort of brokerage? We kind of get what it means to have your money at a bank with FDIC insurance, and we'll cover that here a little bit. But really want to dive down into what happens if the investments that you own, that you are holding at an online brokerage or a traditional brokerage, what happens if they were to shut down? What happens if they were to go bankrupt? What happens to your money? What happens to your investments? How are you protected? Let's go ahead and dive over to the computer so we can show you what we need to know. So right now, there's a lot of stuff going on. Probably one of the most recent things that has happened. I mean, we've seen Silicon Valley Bank shut down, but also what we saw was Credit Suisse. So Credit Suisse, I mean, we're talking a bank that is 167 years old. I mean, 167 years. So they've been around for a hot minute. And recently, they were thrown a $54 billion lifeline from the Swiss Central Bank to shore up liquidity. Now, anytime something like this happens, and we saw this in the crypto space, you'll see this in the banking space, when you have a major player, like a major bank, run into some financial trouble like this, I mean, this can shake up the entire industry. I mean, people get really scared. They get afraid, and then they start going to their banks, pulling out their money because they don't know if it's safe or not. I mean, this is just natural. This is crisis chaos, 101. So this was one of the thing that's going on right now. There's other rumors that it's going to affect Deutsche Bank. We don't know that for sure right now. They're saying they're okay, but we've seen this song and dance before where everybody says, "Oh, we're fine. Nothing's going to happen to us," and then and then something does happen. They're like, "Oh yeah, our bad." But anyway, just this is what the news, this was what is going on. So how does this affect your investments? How does this affect your money? Well, first, let's look at the FDIC side of things. First things first, if you didn't know, and I'll have a link to this in the description, whether you're watching this on the YouTube channel or if you're listening to this on the podcast, I'll have this in the show notes. But if you go to FDIC.gov, they have a list of all of the bank failures since October 1st, 2000. And for those that maybe thought oh, this doesn't happen a lot, I mean, it doesn't happen like every other day. But you can see here that in 2023, we've had 2 bank failures. Prior to that, we had one in 2020. So it had been about 3 years. In 2020, there were 4 bank failures. And I think the total number, when I scroll down here, was over 580, I believe was the number. Not sure where I saw that, but I know I saw that somewhere. But it was over, we'll just say 500, just to call a spade a spade. Oh, here it is, 565. 565 banks have failed since 2000, October 1st, 2000, just to give you an idea, right? So this is not like an everyday thing, but it can happen. It has happened, just to kind of give you an idea. Now, if this were to happen to you, if you have your money at a bank, something were to happen to them, the bank is seized by the FDIC, your money is insured up to $250,000 per depositor. And there are ways to get higher limits depending on how you title your account. For example, if you have a joint account, if you have custodial accounts, if you have a trust account, you can get more than that $250,000 limit. If you have a retirement account, I don't know if I said that or not, but it's worth saying again. So if you have different type of account titles, you can get more than the $250,000 coverage. But for the most part, know that you've got $250,000 of coverage. So anybody that had money with Silicon Valley Bank, which shut their doors was seized by the FDIC on March the 10th, there is a process, and you can read the press release here on FDIC.gov about that process, what that looks like. Essentially, your money is safe up to that certain amount, but there is a process to get that money back. And even though you have that FDIC coverage, it's still a pain, right? It's still a process that you don't have to go through. I'm sure there's a claims process, filling out the paperwork, all that stuff. Like, it's not an overnight thing. So that's how the FDIC process works. Well, what about your investments? What about if you have a money market account invested with a brokerage firm? How does that work? Well, in most cases, the investment firm, the brokerage firm that you are investing with will have SIPC protection. So SIPC is different than FDIC, but it still does protect you. So what exactly is SIPC? Well, SIPC, if any sort of brokerage firm and you could name all the players, Charles Schwab, Vanguard, Fidelity, Robinhood, all of them have to have this SIPC protection. And basically what it does, and actually I'm going to read this. This is from SIPC.org. And I'm going to read it verbatim just so that we get it all down here. SIPC protects against the loss of cash and securities such as stocks and bonds held by a customer at a financially troubled SIPC member brokerage firm. The limit of SIPC protection is $500,000, which includes $250,000 limit for cash. Most customers of failed brokerage firms are protected when assets are missing from customer accounts. There is no requirement that a customer reside to be a citizen of the United States, so on and so forth. So first things first here, right? SIPC protects against the loss of cash and securities, such as stocks and bonds, held by a customer at a financially troubled SIP member brokerage firm. The one thing that we want to make abundantly clear here is that SIPC protects if something happens to the firm. So if you are investing into Credit Suisse and you have investments with them, and they don't have SIPC insurance because they're a bank. But if they're a brokerage firm and they were to fail, your assets are protected. It does not cover you from loss, meaning that if you bought a stock and you bought it at the bad time, if a stock went bankrupt, or if you bought an ETF, or you bought like a triple inverse ETF and you just picked the wrong one, or bad timing and you lose your money, that's not the protection. That's not what it's there to protect you for. It's to protect you if the brokerage firm, if that company, if that investment firm were to go under, if they were to incur some sort of financial hardship where they had to close their doors. That's what SIPC protects. Now, a key word that you want to focus here with SIPC is the word custody. What assets are the brokerage firm, are they custodying on your behalf? And that is a very important word because, and this is it's happened a few times. Probably the most common one that you're familiar with is with Bernie Madoff. So with Bernie Madoff, he custodied his own assets. That means that he held them, or he claimed that he held them. He really didn't, as we know now. So with Bernie, what he was claiming was that he was holding all the assets for his clients. So that is a big differentiator here, because as a comparison, when I was an investment advisor, when I had my own wealth management firm, I had my firm name, which was Alliance Wealth Management. It could have been Jeff Rose Financial, Jeff Rose Investments, could have been XYZ Financial. I could have named it whatever I wanted, had to get the name approved through the SEC, all that good stuff. As far as holding the assets, when clients would send me a check, they wouldn't send it to Jeff Rose. They wouldn't actually even send it to Alliance Wealth Management. They would make it payable to LPL Financial. And you're probably wondering, who in the world is LPL Financial? How does this have to do with anything? So we don't have to get too much into this, but LPL Financial is currently still the #1 independent broker-dealer, the #3 RA custodian. So that was the custodian that I used to hold my clients' assets. And that would be the same thing as a Fidelity, the same thing as a Vanguard, the same thing as a Charles Schwab. So anytime that clients would deposit any money with me, they wouldn't make the check payable to Jeff Rose. They would not make check payable to my firm name. They would make it payable to my custodian, which in this case was LPL Financial. So if you have your assets held with an investment person and they're using Fidelity as a custodian, you don't make the check payable to that person or that person's firm name. You should make it payable to Fidelity, Charles Schwab, Vanguard, et cetera, et cetera. Hope that all makes sense, right? So that is a key difference, because when you are depositing your money with an investment place, investment house, a brokerage firm, they are just custodying the assets for you, meaning that they don't own the assets. You own the assets. You own the stocks. You own the mutual funds. You own the ETFs. It's your discretion. It's your say how that money is invested on your behalf. Now, unless you sign some sort of power of attorney, some sort of agreement that allows that investment advisor to make trades on your behalf, you have full discretion how that money is invested. They can't invest that money for you, which is totally different than what you would see at a bank, right? When you are depositing your money at a bank, you understand that you are giving the bank money. They're paying you a certain rate. Good thing now it's much higher than it was, 5 years ago. Obviously, inflation has crept up with that. But the bank is investing your money on your behalf. They're paying you an interest rate, hoping that they can go and loan that money at a much higher rate so that they can make their spread. That's the understanding. When you loan that money, when you deposit that money with the bank, they're using that money to make money. Difference when you are investing with an investment firm, they have to invest that money the way that you determine, whether that be ETFs, stocks, mutual funds, et cetera, et cetera. And this is a big deal, especially when it comes to that situation. What happens if the firm were to shut down? What happens if you have your money sitting in stocks, money market at that online brokerage or whatever brokerage house that is? What happens to your money? I actually want to give a shout out to Rob Berger and his YouTube channel. He did a video similar to this, talking about the SIPC coverage, or what happens to your investments if your brokerage were to shut down. And I really love the analogy that he used about, think of your money at a bank versus a brokerage firm. And, when you think about, you invest your money at a bank, you're loaning that money to the bank. They are then using that money and then giving out loans, trying to make money, trying to make that spread. Like, that's how banks make money, right? They loan your money out, that you loan them, and they're going to pay you less than what they hopefully will make. And that's how they make money. Now, if you were to take that same money and to put that in a safety deposit box with the bank, they can't do anything with that money. They can't loan it out. They can't borrow against it. Like, it's in that safety deposit box. It is secure in there. And that's similar what you would find with a brokerage firm. When you are depositing your money with that firm, you are basically putting it in a safety deposit box, and then you are deciding how is that money invested. They can't invest that money how they want, how they think that you should invest. Like, you have to give them directions, or you have to sign some sort of waiver that basically says, like, I sign off that you can make decisions on my behalf, but you still have to sign a document, right? They can't, if you put money in a brokerage firm, it will typically just sit in cash unless you sign some sort of waiver, because you have to tell them. Like, that's how the SEC works, Securities Exchange Commission. That's how the investment advisory world works. So I love that analogy. So Rob, thank you for helping me make sense. Hopefully that makes sense to you as well. So then, going back to answering that question, what happens when you deposit your money with a investment firm? We talked a little bit about SIPC, that addresses if the firm were to go under. But once again, we're only covered up to a certain amount. Well, the thing you have to remember is that the assets that you invest into, the stocks, the bonds, the ETFs, the mutual funds, with that investment firm, you own them. They are yours. You have 100% ownership. They are not owned by the bank. They are not owned by the investment firm. So even if it were to go under, so when you think about SIPC, that's covering the cash that you may have with them. That's basically just saying that your assets are protected, but the actual investments, like whether it's a a Vanguard ETF, or you buy Google stock as an example, or Tesla stock. That Tesla, just because the investment firm went bankrupt, Tesla didn't go bankrupt. Like, it's still doing business. It's still doing its thing. Your shares are still held on the exchange somewhere. Like, they still exist. They don't go away. Like, you still have 100% ownership of them. So therefore you are safe. Now, there are, I won't say exceptions to that, but things to know or keep in mind is that a lot of these investment firms, and I went to Investopedia here just to look at what are some of the largest brokerage firms in the US. And you got the usual players here. You got Charles Schwab, Fidelity, E-Trade. I'm assuming Vanguard's on here. From there, you could also add like the M1 Finances, the Robinhood of the world. But you can see that Charles Schwab, according here, has 7.5 trillion under management and 33 million active brokerage accounts. So same rules apply, right? Well, the other part of that is that a lot of these investment firms also have a bank. So you can go to Charles Schwab. Here is their money fund, which is a money market mutual fund that you could invest into. Well, in addition to that, and if you just start clicking on their website, you'll find that they have the Charles Schwab Bank, which is a separate entity than Charles Schwab Investment Firm, or whatever the legal name of their brokerage firm is. So anything that you invest with Charles Schwab Bank is going back to those FDIC rules. Anything that's invested with Charles Schwab is under the SIPC rules. So once again, it's just knowing, what you have, what you own. And if you're not crystal clear on this, you can maybe try to identify, looking at your statement, seeing who's custodied what name is it under. And if it's just more paperwork than you can make sense of, because it's a lot of paperwork typically. I've seen statements, I've seen the disclosures, I've seen all the prospectuses, like all that information, right, is it will put you right to sleep. I always kind of joke when I was still a planner, like, if you suffer from insomnia, just read any sort of investor's prospectus and you'll be knocked right out immediately. But if you don't know, then talk to your financial advisor, talk to somebody that can help you make sense of it. So the thing, though, that you might not be aware of is that depending on how the firm works, I know with LPL Financial, and I have to assume that other custodians, other investment firms are like this, is that you put money in. If it just sits in cash, you have that SIPC protection. Oftentimes, though, they'll have these bank deposit programs or automatic sweep programs. And this could be where it's automatically swept into a money market account. It could be where it's automatically swept into some sort of, like LPL has their insured cash account. And depending on the investment firm, it may fall under FDIC. It may fall under SIPC. Now, for the most part, it's not going to affect a lot of you. But if you know that SIPC protects up to 500, FDIC protects up to 250, well, it's just those limits that you might want to be aware of, because if you have anything over than that, then there may be some concern. Just to know, to make sure that you have your accounts titled the way that they should, maybe to have additional coverage. Maybe you want to not have all your money held at one brokerage firm. Maybe this is why, sometimes it's good to diversify. I know at one point in time, like, it was overkill to have investment accounts at Charles Schwab and Fidelity and Vanguard and online brokers, and maybe you had some stuff at Merrill Lynch or Wells Fargo. It can be very overwhelming to have all these different statements, especially if you're just trying to consolidate and keep things simple. But in this day and age, when you have software programs like Personal Capital, which is now called Empower, when you have the ability to sync all your accounts into one place, long as you do a good job of keeping all of your passwords, all of your logins, keeping them all in a place where it's easy to find, especially if you have a spouse that is into the finances as much as you are. Make sure it's easy for them to be able to log in and see, what you have, how to get access to it. I mean, this is something you need to spend some time on. But as long as you're comfortable with having multiple accounts and syncing all those in one place, like, it's not a bad idea to have your accounts diversified, to have a couple different investment accounts, to have a couple different IRAs, to have a couple different banks. And right now, technology has made it so simple. And there was a day, 10 years ago when I was still an advisor, I would have been the guy, no, you need to have it all in one place. It's so much easier. And that one place needs to be with me. It was a good story. It was a good story. And, truth be told, like, now with technology, it's so easy to track your stuff. Now, I do see people that get a little overkill, a little crazy, and they'll have like 15 different accounts, 20 different accounts. Actually, I might be one of those. In that case, that can be a bit overwhelming, just FYI. But to have just, say 5 or less different accounts, that way, not only are you diversified, maybe an investment strategy, but you're also diversified with that SIPC and FDIC protection. So if you're not exactly sure what you have, log into your account, pull up a statement and see, how is your cash invested? Is it in a money market account? Is it in some sort of cash savings? See if you see bank on there anywhere on your investment account. That way you'll know, okay, this is not under my brokerage firm. This is actually must be their separate entity, which is a bank. So it has that FDIC insurance. And once again, this is worth asking questions about. I mean, right now, when you start seeing all these headlines about Credit Suisse and bank runs and everything else, this is when it's worth a little bit of time to figure out what you have at risk, and just making sure that you have all your bases covered. It may take you 15, 30 minutes, but if this is your nest egg, if this is like all your savings, it's worth taking a little bit of time to understand what you have. All right, y'all, hope you enjoyed this video and podcast. Until next time, this is Jeff Rose reminding you that it's your money, it's your life, and only you could make it awesome. Until next time, peace.